Well, if it's confusing, so I think a metaphor could be helpful here in explaining some of this volatility. I want you to picture a rowboat. If the boat has enough people, it'll be stabilized. If the boat has fewer people and most of them move to one side, that boat may tip in that direction, and that's akin to what we're seeing in the market this week with fewer participants thanks to the holiday. Importantly, though, because the holiday happens every year, right? This is happening against the backdrop of a new market regime, quantitative tightening. In other words, it takes far less to move the market one way or another when there's less liquidity out there. Couple that, though, with greater uncertainty on the macro front, and it's possible to have just a couple of larger players, machine or human, move the market in one way or another, and that's why you have these fast and furious swings like we've seen pretty much every day this week. Now, some of this is due to hedge funds, and within that group, algorithmic traders. That's according to the prime brokerage group at Credit Suisse that tracks this stuff. But the firm says there are other participants also contributing to these moves at the margins, namely mutual funds and passive instruments. But all of this against the time of year with fund managers looking to lock in the best returns that they can muster before December 31st. And you have a recipe for some pretty wild market action.
So do those prime brokerage people like Credit Suisse suggest it might drop a bit when we get through the change of the end of the year, or is this something that's here to stay?
They believe that this volatility is here to stay in the first, at least through the first quarter of next year, just given kind of all of the different contours. Obviously, when you come back in January, there should be more market participants. Everyone comes back to work after the holiday season, so that should help stabilize things a little bit. But the uncertainty is still there. One of the people I spoke with on a prime brokerage desk yesterday said he's never felt this level of uncertainty on the macro front, at least against the counterparties that he's speaking with.
Do you think we're at the point for the hedge fund industry where we finally consolidated it enough? We've taken out enough of the weaker hedge funds that really didn't belong. I think 2018 is going to line up to be, in terms of closings, the least amount of closings for hedge funds we've had in 11 years, despite having the worst performance we've had in 7 years. Do you think we've actually gotten to that point where we've crowded them out enough?
I think it's a good question, and it's one that every hedge fund will lament, but it's almost a prisoner's dilemma, right? Because nobody wants to be the fund that actually shuts down, even though you do need fewer capital in that space, according to researchers. There was a recent report from Morningstar that said that the assets in the industry should actually be more like 200 billion to 300 billion. Right now, it's 3 trillion.
Right.
So that's about a tenth of the size that it actually is for people to start generating real alpha again. But the problem is that everyone's crowding into the same trades. There's so much capital chasing the same kind of return that it just diminishes the ability to do so.
I mean, when you talk to hedge fund managers and some of their top holdings are the FANG stocks, you think, why am I paying this guy 2 and 20 when I can invest in a FANG index? And then when FANG got slaughtered, everybody felt the pain.
Well,
there was it wasn't like they were protecting you from anything.
The hedge fund industry pivoted towards the quantitative model, and the quantitative model by its nature is momentum driven.
Yeah.
And defining what the trend might be. And where are you going to find the trend, where are you going to find the momentum? You're going to find it in the FANGs. So ultimately, what makes you succeed is what makes you fail. And when you see the pullback like you're having now, that's what you're going to experience.
And those who have shorted the FANGs or stayed out of the FANGs have gotten punished. David Einhorn, just to name one, he's been short Amazon. Historically, Tesla, which isn't a FANG, but kind of that same momentum-driven type of stock, he's down about 25% this year.
Right.
Even in a down year. So it's been a trade that people, it's kind of like if you can't beat them, then join them. And a lot of hedge funds have joined them.
I think the one other point is the last couple of years you've had a very calm credit market. So you have not had the dislocations. And remember, hedge funds, the opportunity source a lot of times is in those credit markets. And you're finally getting some dislocations. That could present the opportunity for these hedge funds over the next couple of years if that continues.
But in the context of these giant point swings that we've seen in the discussion about the role that the machines play, the role that the computers play, I mean, it's important also to note that a lot of times the instruments of these momentum traders, whether they be machines or humans, are ETFs. And so when you're talking about the role of ETFs, it's not just the rise of passive amongst retail investors, but it's also the use of ETFs by these strategies, so you're seeing tremendous volume there.
That's exactly right. When you look at inflows into ETFs that you've seen, even as the market keeps going down, a lot of that has to do with shorting, with hedge funds actually hedging, using ETFs to hedge certain positions or certain themes that they're looking at. quantitative traders use ETFs a lot in trying to express those ideas through their algorithms, and so it is a big part of the market.